Okay, it's 4 o'clock, so it's time to start a new season when it comes to monetary policy and the monetary policy report. This first one this year. Welcome to all of you who are here in the room and whoever is listening in or watching wherever in the world you happen to be. Those of us who are sitting here today is Per Jansson, head of the Monetary Policy Department, and myself, Stefan Ingves. And we'll guide you through the monetary policy reports with all the arguments that we have in there about present Swedish monetary policy. And of course, the report contains a huge number of tables, diagrams, and arguments about this, that, and the other. But the way to summarize it this time is to say that as far as we can judge, balance in the economy requires continued repo rate increases over the foreseeable future. And that's because basically, as far as we can judge, the very, very volatile period that we've been through in the past few years, we now have behind us. And that's because global demand going forward is such that it looks okay, of course, with quite a variety when it comes to different countries. And at the same time, given the starting point in the Swedish economy, we're at a juncture where demand conditions and domestic demand conditions are also very favorable. And if you add those two together, then that produces a scenario such that it would not be normal to continue with the very low nominal repo rate that we have presently. So we decided yesterday to increase the policy rate by 1/4 percentage point, and also we have adjusted up the repo rate path somewhat. And as you can see here, good growth in the Swedish economy over the years ahead, but good growth in a sort of a more normal way, because we come out of a period where we have had extremely high growth numbers. Growth numbers they are so high so that it's even hard to find them in a historic perspective. And that means that we don't think that that's the way this will continue, or we are moving down towards numbers between, let's say, 2 and 3% going forward, which is still very good growth, very good demand in the Swedish economy, but something that we're more easily can recognize. And it will be like this because we don't struggle with the difficulties with the public finances. And the labor market is also improving at the same time, and the household sector, looking at it from a domestic perspective, has a very positive view of the world, and that leads to a process where we go through kind of a normalization period, unless something really, really dramatic were to happen in the rest of the world. But as far as we can judge, and weren't that different compared to most others, global growth will be between, let's say, 4.5% over the foreseeable future, which is a good number. What also happens here is that we're kind of back to what we have seen many times before: slower growth in Europe, and then a number of countries in various parts of the world where they show very, very high growth numbers. And this is, of course, also then means that the whole debate, which we aren't going to talk about here today, the whole debate about global imbalances sort of will come back in one form or the other, because basically what this graph shows, that process seems to continue. But what it means, though, when it comes to the Swedish economy is that exports will continue to grow, and that's, of course, important when it comes to aggregate demand in the Swedish economy. Also, basically describing the same type of scenario, if you look at various forward-looking indicators, and this is one way of describing that, this showing purchasing managers' indices in various parts of the world in the manufacturing industry. As you can see here, those numbers are also up, and probably will stay there for quite a while. And that means that we are heading in a direction where there will be good export demand going forward. And these graphs are actually remarkably close to each other. And that's also a good sign in itself. When this then translates into what's going on in the Swedish economy, this can be, of course, described in many, many different ways. We once again have adjusted down our unemployment projection, and as far as we can judge, unemployment will continue to fall. And I'm pretty sure that for several years to come, there will be a debate in this country about at what level will unemployment bottom out. This analysis rests on the assumption somewhere around 6%, just so that you know how we technically have gone about when it comes to doing this. The other side of the coin is to look at the recruitment plans, and as you can see here, looking at the red graph, recruitment plans are going up, and that eventually also will lead to increases in the number of employed. And that then brings us to another phase when it comes to labor market developments, because if you look at labor shortages, some of these numbers are now beginning to look the way they looked in the mid-2000s or early 2000s when we had two other periods with very, very favorable developments in the Swedish economy. Now, given that we're coming from a position compared to the two earlier periods I mentioned, coming from a position where unemployment is higher than it was then of course this means that we have a little bit more available resources in the economy this time. But on the other hand, if growth continues the way we look at it over the foreseeable future, that still means that we'll end up eventually in a situation where there will be more or less full resource utilization in the Swedish economy. And this means, of course, going forward that there is a need for us and many others to keep an eye on what happens to wage developments. And having said that, if you look at the tables in the report this time, we have made a very kind of traditional type of projection when it comes to wages, assuming that wages will develop roughly in the same way as it has been in the past, which means fairly low increases, but increases, if you include increases in productivity, that eventually combined with low inflation produces increases in real income as well. And then we have the Swedish krona, and we always talk about the krona strengthening that we have done since the beginning of the 90s, but this time it has actually happened. And we think that there will be a process that this continues, maybe slightly going forward. One issue here is when one looks at these graphs is the interest rate differential between us and, let's say, the euro area and the U.S. dollar. Eventually, interest rates will start going up in those parts of the world as well, and that means that when that starts happening, then the interest rate differential will have less of an effect. But the issue here is not only interest rate differentials, because we also look at a period where the current account surplus will stay, and where we have basically good growth in the economy, and we don't have problem with public finances the way they have problems in some other countries, and that means that all in all, these factors speak in favor of the krona becoming a bit stronger, which is also something that has been helpful so far, because if you look at global increases in commodity prices, energy prices, foodstuffs, oil, metals, as you can see here, we have a quite rapid increase in commodities and energy prices, and with an appreciating krona, that means that we have imported less of these price changes than what we otherwise would have imported, and that's of course an effect which is quite favorable when it comes to what is going on now in the global economy. Then one factor that one can sort of reflect on a bit here is that why is it that this is going on right now? Because one way of looking at it would be to say, well, if there are various types of supply shocks, then this is something that would be passing and then things would go back to normal. The other way of looking at it, and that's the way that's where we have put emphasis this time, is more to think about this in terms of demand effects in the global economy. And that's basically because we have a number of very large economies that continue to grow, and that will put continuous pressure on these prices for the foreseeable future. And that means that this is not something that likely to, as far as we can judge, pass immediately. Which also means that in this type of environment, we need to factor into the equation domestically to what extent this is actually sort of passed on into future time periods in such a way that there is not a immediately sort of something that people forget about, but there might be second round effects here. And if you translate this into inflation, as we can see, inflation is a bit higher than we expected. Looking at the December graph, which is the blue one, the February projection is a little bit higher than we expected in December. Part of it is oil prices, food prices, energy prices in one way or the other, and that means that we have adjusted up a bit the projection here. But also, if you exclude energy, which is the yellow dotted graph, you can see that basically there is a bit more inflationary pressure in the economy than what we have seen in the past, which is maybe not so surprising given the growth numbers that we have had, and that we are gradually here moving towards a state of the world where we will have full resource utilization in the Swedish economy. It's also worth adding, which is not on this particular graph, but which sort of goes in the same direction, that inflationary expectations, at least in the short run, are also moving up, and that probably also reflects what has happened when it comes to, let's say, food prices and energy prices. And if this is then translated into inflation numbers, we'll see here that we'll be fairly close to target, given that our CPA includes interest rate increases, and that's the main factor why CPI will be above target during the period that we're looking at here. But CPI-F, as you can see, will be quite close. And then, in order to achieve this, we need to increase the repo rate slightly faster than what we have said in the past. Basically, factor a little bit higher inflation into the equation. And what this graph tells us is that what is most likely to happen here in the course of the year is another 4 increases or so in the course of the year. And of course, given now that the resource utilization will be pretty much close to what is possible in this economy, then that also implies that we are over time actually moving towards an interest rate level, which is something that we're more used to recognizing when it comes to how the Swedish economy is sort of behaving. But as always, it's a forecast. It's not a promise. So there are various scenarios that eventually will produce outcomes such that we either end on the upside or on the downside. And Per will go through a few of them.
Thanks.